All right, welcome to the Deep Dive. Today, we're going to be talking about something that you probably see every day, but maybe haven't thought about it much as a signal for how the stock market might move. That's the number of followers a company has on Twitter, or I guess now X, and maybe more importantly, how fast that number is growing.
Yeah, we're going to be putting aside the usual looking at balance sheets and income statements. And our mission today is, can we actually track a company's kind of like rising popularity, right? And can that give us a shortcut or kind of a quick way to see, hey, is this a company that's actually doing well and could be a good investment?
Right.
And potentially cut through some of the noise of like traditional financial analysis.
Yeah, and it's not just a hunch, right? Like we've got some really interesting data from an academic study that specifically looked at this connection between a company's Twitter, now X follower growth, and how their stock is actually performing.
That's right, yeah. And we're not just talking about like a viral tweet here or there. We're looking at sustained growth in a company's followers over time as a possible indicator.
Right.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
And I think just to really kind of grab your attention right off the bat, consider this. The research actually found that an investment strategy based on keeping an eye on how a company's Twitter following is growing could actually beat the market. And it was particularly effective when they looked at like the daily changes, like, day over day, showing an average yearly return of 12.3%.
That's a lot.
Yeah. So, okay, let's unpack this a little bit. Can something it sounds so simple.
Right.
More people hitting that follow button, does that really tell us anything about where a company's stock might be headed?
I mean, what I think is really fascinating about this is the basic idea behind it really comes down to where investors are focusing their attention and how information is flowing in today's world. So social media platforms, especially Twitter, they've become these huge places where investors are kind of congregate and where their interest gets sparked.
Right.
The study we were looking at actually mentioned this 2021 statistic, and it said that a full 60% of investors under the age of 35, they use social media as a source for getting their investment information.
Wow.
That's a huge amount of the investing population that's, at least partially plugged into these online discussions.
Yeah, not just for quick updates. It's really a place where ideas can gain traction.
Precisely. It's a very active environment where investors can get, breaking news, they can share their opinions, they can access market information very quickly. And so this increased transparency can actually, help to level the playing field a little bit, reducing the gap between like what the big institutions know and what the average investor knows.
Right. Okay, so how does just somebody deciding, hey, I'm going to follow this company's Twitter account, how does that become a signal for, maybe this company is actually a good investment?
Yeah, well, the core theory here is that, when you see a company's followers increase, right?
Yeah.
That likely means there's growing attention and interest in that specific company from the broader market.
Yeah.
So think about it like when, a public figure or like a celebrity, right, experiences this huge jump in their followers after, some big event or something like that. It reflects a surge in public interest. And the same thing can actually happen with companies.
Okay, so you're saying, like, if a company, say, announces something big, like, a groundbreaking new product or really positive earnings, you would expect to see more people in the investment community maybe start to follow them, just to stay in the loop.
Exactly.
We see that a lot with companies, in like hot sectors these days, like EVs and AI. People want to follow those companies as the story develops.
Exactly. And so this increased investor interest that we're talking about, which we can actually see, by looking at the follower growth, this could be a sign of how well the stock is going to perform in the future, right? So more attention on the company, more people are talking about it, and that potentially leads to more demand for the stock.
Yeah. Okay. So are there certain kinds of companies where we see this follower growth happening more, significantly?
Yeah. The study did highlight some interesting patterns. The consumer goods and high technology sectors really stood out.
Okay.
They were leading in both their total number of followers and also how fast those follower counts were increasing.
Okay.
So this suggests that, for companies that deal directly with consumers, engaging on social media could be super beneficial.
Right. It makes sense. You're probably more likely to follow a tech company whose products you actually use every day, or, a clothing brand that you like, than, a utility company.
Exactly. Sectors like energy and utilities, they tend to show lower levels of social media engagement in general.
Right.
Now, here's where it actually connects to the more traditional finance side of things. The research found that companies with stronger monthly follower growth also tended to have rising stock returns and increasing earnings per share. And interestingly, it also kind of matched up with a downtrend in what's called book-to-market ratios.
Okay, hold on. Let's break that down a little bit. So we're saying that companies that are getting more followers, they're not just getting more popular on social media, they're also the ones whose stock prices are going up. They're showing better profitability.
Right.
And that lower book-to-market ratio that suggests that these are often the companies that are seen as growth companies as opposed to the so-called, value stock.
Exactly. And one more thing the study pointed out is that bigger companies, so larger companies, they are more likely to see significant follower growth.
Okay.
This could be because, they've already got a big brand, they have more resources to put into social media, or they just have a bigger audience already to tap into.
Right. Okay, so let's get into the practical application. How did the researchers actually test if this follower growth, could be used as a real investment strategy? What were the results?
Yeah, so they came up with a specific investment approach. They called it a long-short strategy.
Okay.
So here's how it worked. Every day, they looked at all the publicly traded companies and they took the top third, right? The ones that had the biggest increase in their Twitter followers just that day.
Okay.
All right. And then they basically said, we're going to pretend to invest in these top gaining companies. And that's the long part of the strategy.
Okay.
At the same time, they also did what's called shorting the S&P 500 ETF, which is basically a bet against the whole market overall.
Right.
That's the short part of the strategy.
Okay.
So they gave this little simulation, they gave it a name. They called it the HM S&P portfolio.
Okay.
So essentially they're saying, we think that the companies with the biggest jumps in Twitter followers each day are going to do better than the overall stock market.
Okay. How did this strategy actually perform?
So here's where it gets really interesting and potentially very, very useful for you to understand. The version of this strategy where they rebalanced daily, so every single trading day, they looked at these followers and they adjusted their little pretend portfolio. That version had an average annual return of 12.3%.
That's huge.
To put that in context, that is a lot higher than the average return you would normally expect from the stock market. So on top of that, they had a very, very impressive what's called annualized Sharpe ratio of 2.08. Think of the Sharpe ratio as a way to measure how much extra return you're getting for the risk you're taking.
Okay, yeah.
So the higher the number is, the better it is, basically.
Okay.
And the biggest drop, from a peak to a low point, which is called maximum drawdown, it was only about 5%.
Okay.
So this means you have a chance of making a lot of money, and it seems like the risk isn't that bad compared to just investing in the market as a whole.
Wow. 12.3% average annual return with that level of risk. That sounds pretty amazing. What happened when they tried, adjusting the portfolio less often?
Right. So they also tested a version where they only rebalanced it once a month, based on that whole month's worth of follower growth.
Okay.
And while this monthly rebalancing strategy, it did show positive returns, it wasn't nearly as good as doing it daily. It suggests that, those little bursts of attention on social media, they can show up really fast in the market.
Yeah.
It's like the market reacts pretty quickly to whatever's driving that social media buzz.
That's really interesting. But I'm sure there are some, real world things to think about too, right?
Oh, absolutely. Yeah. The researchers were careful to point out that these returns that they're reporting, they don't include things like transaction costs. If you're trading every single day, buying and selling stocks that often, that's going to cost you money in fees.
Yeah.
And that could really eat into those profits that we were just talking about. So while the signal, the idea of looking at follower growth, it seems really strong, actually making money off of it depends a lot on how much it costs you to buy and sell those stocks.
Right. That's a really important thing to keep in mind. Okay, so this idea of investor attention and how information flows, that's at the heart of why this strategy might actually work. Can you talk more about that?
Sure, sure. So in today's world, social media like Twitter, these have become super important places for investors. It's where they get their news, they share opinions, and they can kind of sense the mood of the market.
Right.
But the problem is there's so much information out there that it can be really overwhelming.
Yeah.
So investors are always looking for something, anything, to give them a clue about where to put their money. And when you see a big jump in a company's Twitter followers,
It's basically saying, hey, people are paying attention to this company.
right,
And that increased visibility, well, that can lead to more people researching the company, which then might lead to more people investing. And that's what can affect the stock price.
it's like digital word of mouth almost, can actually have a real effect on a company's value.
That's a great way to put it.
And because information spreads so quickly on Twitter, these changes in attention can happen really fast, which might explain why that daily rebalancing strategy was so effective.
It's true. It was basically riding the wave of these short-term bursts of attention. So here's the thought I want to leave you with. In a world where everything is becoming more digital, are these social media numbers becoming a new kind of early warning system for how the market feels and where stocks might be going? How can you start to see these trends when you're looking at the market?
That's a really interesting question. I would encourage you to just kind of casually observe what's happening on social media with the companies that you're interested in.
Yeah.
See if you notice a connection between like when they get a lot of new followers and then what happens with their news or the stock price. This study really makes us think about how all these digital signals might be reflecting what's happening in the financial markets.
It really does. Well, thanks for exploring this really fascinating topic with us today. We'll catch you next time.